All right, so there's a pretty crazy story coming out of Zimbabwe. So Zimbabwe has banned the export of raw lithium from its globally important reserves. So Zimbabwe is not only mineral rich in terms of lithium, but it's also mineral rich in a lot of other areas like gold, for example. But it has not seemed to really be able to bear the fruits of its minerals and what it has. And this is a really big important lesson in terms of developmental economics. And so there's a big difference between economic development and economic growth, and we're going to talk about that here. But lithium is now a huge, high demand mineral simply for the fact that the future is electric, and so to make electric car batteries, a huge element uses lithium here. So it says Zimbabwe has banned the export of raw lithium as it seeks at least first stage processing within the country for the critically important metal. Any export of lithium ore will now require special permission under a new statutory instrument regulation. If you don't know what a statute is, by the way, statute is a law specifically passed by Congress. So not an executive order, not court-made law, which is called common law, like Roe versus Wade, for example, but a law specifically passed by the legislature. In our case, it's Congress, but in other countries, it can be parliamentary. With exporters required to show, quote, exceptional circumstances before moving lithium out of the country. Even samples sent for assay, I don't know what that means, in other countries will require government permission. The high price of lithium has attracted artisanal miners who target abandoned mines in search of rock that is then exported, Zimbabwean President Emerson Mnangagwa previously said. I don't know if the M in that name is silent. It says companies based in China, itself a huge producer of lithium, have recently secured the rights to mine and process large quantities of lithium in Zimbabwe. Such operations, which process raw hard rock lithium ore that contain little of the metal into lithium concentrate, will not be affected by the ban. But Zimbabwe hopes to go beyond that with local manufacturers of lithium batteries that power cell phones and electric vehicles. Formal miners applauded the ban. Several lithium mines have long operated in Zimbabwe, including the Bikita mine, on the largest known reserve of lithium in the world. Overall, only 4 other countries in the world have bigger lithium reserves. But even as demand for lithium has spiked, with forecasts of shortages over the next decade, Zimbabwe has remained far behind in production. In 2021, Australia produced about half the world's lithium, with Chile and Argentina's output making a combined 30% of the total, and China responsible for some 13%. Meanwhile, Zimbabwe produced 1% of global output, slightly behind Brazil. It had expected that number to hit 10% by now, a number which, if achieved, could dramatically reduce the anticipated long-term shortages of lithium. So basically, there's a lot of untapped potential here, not only for Zimbabwe, but for the entire world. And so this is a huge thing about developmental economics as well as trade economics, right? And so now I could come to you and make this video saying, oh, this is awesome. Zimbabwe is fighting off its imperializers and it's nationalizing its mineral supply. It's a very basic second grade level analysis that would be really good for views because people just kind of consume that stuff. But we're going to try to avoid that. We're going to try to go above that and do a real actual political and economic analysis of what the heck is actually going on, not only here in Zimbabwe, but also global economics, global trade economics, as well as developmental economics. I'm a little bit in terms of information deficit in terms of developmental economics. And so the real key here is understanding the difference between economic growth and economic development. If you want to try to answer what it is, I recommend pause the video, try to come up with the idea before I tell you what it is. But economic growth just means that your gross domestic product increases. So, for example, let's say Zimbabwe comes across a big mine of lithium. And it's like, whoa, it finds that mine of lithium. That's a lot of money that's going to increase the gross domestic product. That's called economic growth. Economic development is increasing your infrastructure and ability to create things. So, for example, let's say Zimbabwe increases its technological resources, or it increases its healthcare or education, because those increase your production possibilities frontier curve into being able to create more things. So that's called economic development, increasing, having property rights and actually sound political institutions. Those are all things that are called economic growth. And so, as an example, or there's economic development. And so, a lot of times these countries will have economic growth that's 100, 200% of GDP, but it's really not much, and it's hugely waste of potential, because really what they need is economic development, not growth. And that's the core issue here, okay? The core issue here. And so there's a lot of stuff going on, but here's what's crazy. So this is the article from 2015. It says Zimbabwe loses $12 billion to multinationals. So Zimbabwe has lost an estimated $12 billion through illegal trade involving multinational companies from rich countries involved in the mining sector here. The amount siphoned off is enough to pay off the country's total debt, estimated at just under $10 billion. A new report entitled Capital Flight, Natural Resources and Institutions in Zimbabwe, and compiled by Zimbabwean researchers and academics, revealed that the multi-billion capital flight has taken place over the last 3 decades, largely through falsified invoicing. According to the researchers, trade in the major minerals involves companies from Zimbabwe's main trading partners, which include South Africa, Canada, Australia, UK, China, and the US. And so we're actually going to look at this study. This is the actual hard study here. You can see this is an actual real study. So it's titled Capital Flight, Natural Resources and Institutions in Zimbabwe by Marco Kwaramba, Nyasha Mahonye, and Leonard Mandishara, to be presented to the Center for the Study of African Economics, CSAE Conference 2015, Oxford, UK, on Economic Development in Africa. It says the study investigates the link between capital flight, natural resources, and institutions in Zimbabwe. It also explores mechanism of capital flight by estimating trade misinvoicing. Econometric estimation results showed that the higher the macroeconomic instability, the higher the capital flight. This implies the government should ensure macroeconomic stability by introducing policies which reduce inflation and exchange rate volatility to curb capital flight. The results show a positive relationship between capital flight and natural resources rents, implying higher capital flight as a derivative of high natural resources rents. This implies that the government should introduce proper policies that are transparent and that do not scarce away continuous investment in natural resources. Lastly, institutions have a negative relationship with capital flight, as theoretically expected. It implies the government should increase the effectiveness of institutions to reduce capital flight. Now, I didn't know what natural resources rents was, but I guess that the rents are the creation, the profits made off of the resources, subtracted by all the inputs that were required to basically extract the resources, if I'm not mistaken. And then also, this is a new thing that I learned, was trade misinvoicing. I didn't know what trade misinvoicing was, but I guess this is trade misinvoicing. It says trade misinvoicing is a method for moving money illicitly across borders, which involves the deliberate falsification of the value, volume, and or type of commodity in an international commercial transaction of goods or services by at least one party to the transaction. Trade misinvoicing is the largest component of illicit financial outflows measured by global financial integrity. And so this is a developmental economic issue in the entire developing world, in which there's extreme amounts of trade misinvoicing, in which there's fraudulent invoicing of imports and exports that take money out of that country. And so they can do that either by inflating the price of the goods that they are exporting or importing, or you can do the reverse and just have higher quantities and lie, right? So here's a diagram, this basic trade misinvoicing diagram. You have the U.S. exporter, which invoices $1 million to this entity right here, this middleman entity, and then they invoice the Indian importer $1.5 million. So it's falsifying basically $500,000, which then gets diverted into an offshore account. And so you're basically scamming the importer $500,000 as the exporter, right? So you're getting a bunch more dough here. Is what it ends up looking like in terms of the importers. This one is actually the importer getting the $500,000, and so you can see that this is how it goes, and it could be the reverse too. It could be on the export side as well. So it also leads to tax evasion and that kind of thing. But here the study here explains that there's tons and tons of capital flight, and it's saying that there's a bunch of reasons for this, but a lot of lack of stability as well as foreign ownership of the mines themselves is actually the cause. But what we can see here is there's a linear regression test run here. This is what an econometric linear regression test calculation looks like. And so a linear regression test basically it does a line where it's looking at correlation between multiple variables. And so it's seeing like corollary relationships between variables. And so the results of this econometric linear regression test are shown in this chart here. So you can see the correlation matrix here. So capital flight, it has 0.33 relationship with natural resource rents, negative 0.08 with property rights, negative 0.50 with political rights, negative 0.19 with GDP, inflation is 0.80, exchange rate is 0.94, institutions negative 0.57, 0.82 macro instability. So what does that mean? These are descriptive statistics. This is why it's so important to learn how to understand this stuff. And I'm learning this in class as well. But basically what this is saying is the higher the number, the more it correlates with the original variable. The lower the number, the less it relates to it. It actually goes in the opposite direction. So what that's saying is there's a 0.80 like corollary relation with capital flight. So that means there's a really, really high close relationship between the two. So when there's high inflation, there's high capital flight. Political rights, which is negative 0.50, is the opposite. It means that there's a very, very negative relationship between the two, in which when there's political rights, it is much, much less likely to correlate with capital flight. That's essentially what this is saying. So it says Table 4 shows that natural resource rents, political rights, inflation, exchange rate, institutions, and macroeconomic instability has significant correlation with capital flight. Capital flight and natural resource rents has significant and positive correlation. This suggests that capital flight is a phenomenon associated with countries that have higher natural resource rents. Capital flight, institutional quality, property, and political rights, and macroeconomic instability have negative and significant correlation. This suggests poor quality institutions and a bad macroeconomic environment are associated with higher level of capital flight in Zimbabwe. Political and property rights are negatively and significantly correlated with measures of macroeconomic environment. A good institutional environment is likely to associate with low levels of inflation and strong local currency. And so you can see the regression results here as their coefficients. But basically what this is saying is very high inflation, volatile exchange rate, macroeconomic instability, natural resource rents is less correlated, but these are all correlated with capital flight. You can see the very high coefficients, right? 0.8, 0.94, 0.82. Political rights, property rights, institutions, these are all negatively correlated. GDP, you can see, 0.08, 0.50, negative 0.57. So when you have good institutions, that is a negative correlation with capital flight. That does not correlate with capital flight in that linear regression test. But you can also see in this chart here, you can see that there's like a comparison of total misinvoicing for ores, copper, and nickel. And you can just see how much of a misinvoicing is in terms of how much they're taking out and how much they're scamming, how much countries are scamming. South Africa is actually doing the opposite. They're doing it in the opposite direction, where they're bringing money in as opposed to taking it out. Belgium has done the same. But you can just see how much money is being taken out by Canada, Germany, India, United States, the UK. They're just scamming the hell out of them, basically, is what you can see. So that's all the total misinvoicing going on. Here's also some more context to Zimbabwe. It says analysts predict economic struggles for Zimbabwe in 2023. Ahead of the 2023 polls, there are concerns that Zimbabwe's economic woes could spill over. This month, inflation in Zimbabwe peaked at 280%, one of the highest rates globally. The Zimbabwean dollar also weakened, trading at $9.30 to US dollar on the parallel market, a steep decline after 2 months of relative stability at 700 to 1. This led to plummeting living standards in the southern African country, where 7.9 million people, more than half the population, fell into extreme poverty between 2011 and 2022. Ahead of the crunch 2023 presidential elections, proposed currency reforms by the incumbent Emerson Mnangagwa's administration have already been put on hold. Unsurprisingly, economists, political scientists, and multilateral institutions are sounding the alarm that the trend of declining economic fundamentals could continue till next year. During a recent visit to the country, the IMF predicted a further fall in the gross domestic product by 3.5%. And so basically, they just keep printing too much money, and so it's easy to quickly print a bunch of money for the short term to be able to win elections. And so this is why economics and politics are just so closely intertwined. because they keep increasing the money supply, and so there's incredible amounts of inflation that's going to result in a really terrible economy because things are going to be so expensive that people can't afford it. Your currency becomes useless. Capital flight is going to go up because your currency is worth less money, and so they're going to want to take it out into higher value currencies, right? And so this is a really bad move on Zimbabwe's part, and this is why it's so important. But what you can see is there's this corporate thing, right, where it's like corporations are taking out money, right? But what's also a huge problem, and apparently over 60% of the problem with like gold mining, is that there's just like basically random people. Here it is. It says, according to government statistics, the bulk of the gold is extracted by artisanal and small-scale miners who are responsible for 63% of the recorded production. In most cases, the artisanal miners operate illegally and do not sell the mineral to the state-owned buyer. So having like a single state-owned buyer is also questionable, honestly. Like having a monopoly buyer, you're only having, one person as the purchaser in the goods market. I mean, that's terrible, right, for the product. I mean, just imagine if like, somebody was the only buyer, one person was buying an entire good. But it's like this artisanal miner is like some small scale miner who goes in and grabs it and then, illegally sells it, right, into another country. And so the capital leaves elsewhere. And they're losing tons and tons of money through smuggling. And so when I've been reading the Federalist Papers, and one of the things that Andrew Hamilton says early on, and I think like Federalist 13, I believe it was how important, one of his arguments Hamilton makes for the Union, is actually that if they are a confederacy and not a union, it's going to be much more difficult to stop illegal importation of goods and dodging of taxes, because at the time, income taxes came way later, especially federal income tax. I mean, remember, there was a constitutional amendment passed to the 16th Amendment to make federal income taxes legal. So at the time, he's like, the only real way to do it is excises and duties. So, taxes on imports, right? And so he says that, France had like 20,000 patrolmen just patrolling like their seas to make sure that illegal importation didn't get in. They were losing so much money. And so you lose so much money from smuggling. And this is why politics and economics go super in. And so what it also says here is it says, Kombarai says the situation in the mining industry has been worsening since Mnangagwa came to power because the government's policies support corruption and the few who benefit are politically connected. The case of Henrietta Rushwaya is a clear revelation of how the Mnangagwa regime has been supporting corruption. She was arrested with 6 kilograms of gold, but the main question is how much has he smuggled in without getting caught, and how many others have succeeded in smuggling without getting caught. So basically, there's super huge amounts of corruption to the point where it's like the people who are in power, like Mnangagwa, like they are the ones making the money. They're the ones doing the smuggling oftentimes. This is police interrupt truckloads of lithium ore. And so this is the problem, right? And so here's the thing, right? Capitalism requires strong property rights. This is one of the big things, Lockean like theory, essentially. You need property rights, right, as the most important. You can't have capitalism without property rights. And so people in these third world countries want capitalism. They want those property rights. But you can't have capitalism without property rights. And so there's no actual official property rights that are legitimate. It's all corrupt. It's super corrupted. And so really, analysts are saying that this ban isn't even really going to do all that much because there's so much political corruption in Zimbabwe that it's not really going to lead to any sort of differentiation, right? And so this is hugely problematic for Zimbabwe. And so this is a good move potentially, but what Zimbabwe needs to do is stop printing so much money, make it so that you have a good, stable macroeconomic conditions, because like China, for example, was able to really come back to life after Mao's horrible reign, after he finally died and Deng Xiaoping took over and opened up the markets. And I think the main strategy China had taken was to, because subsistence farming is really the death of economies, right? And India is still dealing with this, right? I think like a majority of its workers are still doing subsistence farming because it just takes up so much resources in terms of land, time, and resources, and it makes almost nothing. So it's economically extremely inefficient, right? And so the big thing I think they did was they started investing in rural farming to make it more economically efficient by offering cash money, as opposed to like the communist Soviet plan, which was to just make like the agrarian farms and then industrialize from there. Although it looked like Mao didn't even really want to industrialize like that. He just wanted to make the group farms because he was more the peasant, revolutionary kind of guy, the farmer peasant revolutionary. That was his like twist on communism, right? Whereas Stalin's communism was like let's freaking industrialize at gunpoint, basically, right? So that's the big issue. Zimbabwe needs to make solid economic decisions in terms of, because the thing is, when China opened up its markets, it got tons and tons and tons of foreign investment. And that's what really spurs an economy, is that tons of foreign investment. And so if you're in a country where property rights are not solid, you're not going to have companies come in because there's no protection for their companies or profits. And so you have to have solid property rights in that country, and then you'll have a lot of foreign investment that stays in the economy, and you'll have a stable economy that people go in. Generally speaking, the more protection and future profits there are in a country, the more investment it's going to get. And so that's a big problem, and corruption needs to be rooted out. I don't think it's going to happen, unfortunately, just with the way that it works. I just don't think that it's going to end up being fixed, unfortunately. But that would be the real way to solve the problem. If Zimbabwe wants to become an actual, really like developed economy, you need to do solid monetarist policies, like stop printing so much money, make sure that you have solid property rights, political rights, get rid of corruption, which is almost impossible, right? Even the U.S. deals with a lot of corruption, but it's nothing close to somewhere like Zimbabwe. And then open it up, and you're going to get a bunch of, not even open it up, but just like having those actual property rights, businesses will come to you. Having a stable economy brings companies and foreign investment to you. And that's really what makes these countries big. Like South Korea was also really, really able to get to where it's at out of, the previous days it was in by becoming an export economy. But you can't really be an export economy without a bunch of, foreign investment. And so if Zimbabwe wants to get to that point, that's where it's going to have to get to. And so this should be beneficial in terms of like, it should bring jobs back to Zimbabwe by forcing them to process things there. However, if they don't do the stuff that I'm listing there, it won't do all that much because there won't be much investment, and you're just going to see lots of illegal artisanal mining, lots of illegal misinvoicing, and you're just going to see a lack of investment, and there's going to be a ton of potential that's not going to be realized by Zimbabwe. And so this is why it's crazy, because you can't really have solid actual economic development with like really good political institutions as well. You guys saw the regression test, right? You guys saw the results of this regression test. The regression test shows that the huge correlation, negative 0.57 for solid institutions, negative 0.50 for political rights, negative 0.08 for property rights. And so that means that they're negatively correlated with capital flight, meaning that they don't happen with each other. They diverge from each other. Whereas inflation, exchange rate volatility, macro instability, they stay together. So that means when there's a lot of macro instability, you have capital flight. When there's exchange rate volatility, you have capital flight. When there's inflation, you have capital flight. However, when there's high political rights, they diverge. Capital flight goes down, right? Same thing with the solid institutions. And so that's really the solution here. I don't think this is really going to do all that much in terms of, because like people just won't, like countries just won't really invest that much in Zimbabwe because the economy is not solid, right? And so it's not going to solve the issue. And so analysts in Zimbabwe are sort of saying like, this doesn't really do anything anyways, because the people who are controlling the government are being corrupt themselves, and the ones doing the corruption. So while this is really cool, there's way more that needs to be done by Zimbabwe, and it could definitely get to being like a serious developed economy with a robust healthcare system, high education, educational access, high technology, etc. But it needs to follow those things. Stop printing so much money, and have solid macro policies. Get rid of corruption. Create solid government policies. Create solid government institutions as well as political rights, and your country will flourish. It'll be absolutely just completely flourishing, because you'll have because then you can actually have those jobs in your country, right? Because foreign countries will be wanting to invest. And so what they're basically saying is we want foreign investment in our country because they don't want to export those raw goods. They want them to process those raw goods in Zimbabwe. So they're literally asking for foreign investment, right? And so I know a lot of like progressives or whatever think economics is not real and all this stuff or that kind of stuff. No, like they're literally saying, what they're saying is we want foreign investment into our country. That's what they're saying. And so that's the thing, right? They want companies to come to Zimbabwe, create companies that are going to utilize that lithium to process it in Zimbabwe as opposed to in other countries. So those are the things that it needs to do. Solid property rights will lead to it. And that's the biggest developmental econ issue is really property rights is what it comes down to. Because if you don't have property rights, everything becomes the black market smuggled. And you can see the artisanal miners and how much money is just getting out of Zimbabwe because of it. But then not only that, but you're also just going to have lack of foreign investment. And all countries need foreign investment to be able to be a developed country. So that's what Zimbabwe needs to do. And developmental econ is a super fascinating subject that I definitely hope to get into more.